channel. If you watched our last video, you know exactly where millionaires store their wealth and the precise order of accounts you need to fill to optimize your taxes and maximize growth. But right at the end of that video, I made you a promise. I told you we were going to take this system to the absolute next level, because knowing which account to open is only half the battle. The moment you actually log into your Fidelity, Vanguard, or Charles Schwab account, or the moment you open your employer's 401k portal, you are hit with a massive, intimidating wall of financial text. You are greeted by a dizzying alphabet soup of ticker symbols, mutual funds, exchange-traded funds, mutual fund windows, and expense ratios. If you don't know exactly what you're looking at, it is incredibly easy to panic, pick the wrong asset, or worse, paralyze yourself into doing absolutely nothing at all. Today, the guessing game ends completely. I have spent over 20 years in wealth management sitting across from multimillionaires, and today I am taking you behind the curtain. We are going way beyond basic investment theory. I'm going to show you exactly how to pick the specific funds inside each of your accounts, the hidden traps to watch out for, exactly what to look for and what to avoid in a target date fund, and how to build the ultimate portfolio allocation custom-tailored to your specific age, timeline, and risk tolerance. No gatekeeping, no complicated jargon, and no hidden agendas. Just the exact operational blueprints. Let's dive in. The very first hurdle you will face when trying to deploy your money inside an account is choosing between an ETF, or exchange-traded fund, and a mutual fund. If you search online, you will find endless academic debates about which one is better. But for the long-term wealth builder, they actually do almost the exact same core job. They buy a diversified basket of assets for you so you don't have to buy individual stocks. However, the operational differences matter significantly depending on the type of container you are using. Let's look at the mechanics. An ETF trades exactly like an individual stock on the open market. It has a ticker symbol made up of 3 or 4 letters like VTI. You can buy and sell ETFs throughout the trading day at fluctuating prices, and you can buy them in fractional shares or single-share increments. This makes ETFs incredibly flexible and highly tax-efficient, especially inside a taxable brokerage account, due to the way shares are created and redeemed behind the scenes. A mutual fund, on the other hand, usually has a 5-letter ticker symbol ending in the letter X, like VTSAX. Mutual funds do not trade in real time. No matter what time of day you place your order, the trade is executed only once per day, after the market closes at 4 p.m. Eastern Time based on the net asset value, or NAV, calculated at that moment. Furthermore, many premier mutual funds require an initial minimum investment, sometimes $3,000 or $10,000, before you can buy even $1 of the fund. Here's the professional rule of thumb for your account structure. Inside an employer 401k or 403b, you will almost exclusively see mutual funds. This is perfectly fine. The investment minimums are waived by your employer's institutional plan, and automation works flawlessly here. Inside a Roth IRA, traditional IRA, or taxable brokerage, I generally lean heavily toward ETFs. They provide maximum portability, complete tax efficiency, and no artificial minimum investment requirements. Regardless of whether you choose an ETF or a mutual fund, the financial services industry has built a maze of hidden traps designed to siphon off your returns. To survive this maze, you must run every single fund option through 3 strict golden filters. Filter 1, the expense ratio filter. The first and most critical metrics you must look at is the expense ratio. This is the annual management fee the fund charges to run the portfolio, and it is deducted automatically from the fund's assets. It is always expressed as a percentage. A high-quality, passively managed index fund will have an expense ratio well under 0.10%. Many legendary funds from Vanguard, Fidelity, and Charles Schwab sit between 0.03% and 0.05%. This means that for every $10,000 you have invested, you are only paying $3 to $5 a year to hold the fund. Conversely, an actively managed fund, where a highly paid Wall Street fund manager claims they can pick winning stocks to beat the market, will regularly charge an expense ratio of 0.75%, 1.0%, or even 1.5%. Do not fall into the psychological trap of thinking that a higher price tag equals a better product. In the investing world, you get exactly what you don't pay for. Over a 30-year career, a seemingly small 1% difference in fees will compound in reverse, eating up over $100,000 to $300,000 of your ultimate nest egg. When you look at your fund choices, if the expense ratio is higher than 0.20%, you need a phenomenal non-negotiable reason to hold it. Otherwise, reject it. Filter 2. The load fee. Filter. The second filter is checking for sales loads. A load is a blatant commission charged by a fund company just for the privilege of buying or selling their fund. A front-end load takes money off the top the moment you invest. For example, a 5% front-end load means if you invest $1,000, only $950 actually goes into the market, while $50 goes straight into a broker's pocket. A back-end load charges you a fee when you try to sell your shares. Wealthy investors never pay load fees. You are looking for strictly no-load funds. If a fund menu options contains sales loads, run the other way. Filter 3. Assets under management, AUM, and liquidity. The third filter is size and track record. You want to look for funds that have a massive pool of assets under management, ideally over $1 billion. Large funds benefit from economies of scale, which keeps their internal trading costs low and ensures that the fund tracks its target index with microscopic accuracy. Choosing an obscure, tiny fund with only $50 million in assets introduces liquidity risks and tracking errors that can quietly degrade your performance. Now let's tackle the most ubiquitous option found inside modern retirement plans, the Target Date Fund, TDF. If you open a 401k today, odds are your plan has automatically defaulted your contributions into one of these funds. Target date funds are often marketed as the ultimate set-it-and-forget-it solution for ordinary people. You simply look at the fund's name, find the year that matches closest to when you turn 60 or 65, such as a Target Date 2060 fund, and you dump 100% of your contributions into it. The mechanics of a target date fund are elegant in theory. When you are far away from retirement, the fund is structurally aggressive. It allocates roughly 90% of your money into domestic and international stocks for maximum wealth accumulation. As the years tick by and you approach that target year, the fund automatically, systematically, and silently shifts its internal allocation away from volatile stocks and into stable income-producing assets like U.S. Treasury bonds and cash. This mechanical transition is known as the fund's glide path. Target date funds are an outstanding tool for investors who experience extreme anxiety around managing money or who suffer from severe analysis paralysis. They remove human emotion completely. But as a financial strategist, I need to give you the unvarnished reality. Many target date funds are constructed poorly, and if you buy the wrong one, you're giving up massive amounts of growth. Here is exactly what you must look for under the hood. First, you must determine if the fund is an active target date fund or a passive target date index fund. An active target date fund is a fund of funds where the manager populates the portfolio with expensive, actively managed underlying mutual funds. These routinely carry high internal expense ratios of 0.50% to 0.85%. A passive target date fund, however, builds its glide path using cheap, underlying market index funds. These usually cost between 0.08% and 0.12%. Always verify that the word index is explicitly stated in the name of the target date fund. Second, you must analyze the structure of its glide path at the point of retirement. Target date funds generally fall into two strategic camps: to retirement funds and through retirement funds. A to fund assumes you will liquidate or transition your money out the exact year you retire. Therefore, it reaches its most conservative, bond-heavy stance right at the target date. A through fund assumes you will keep your money invested in that same fund for another 20 to 30 years throughout your retirement. Consequently, it maintains a healthier, more aggressive stock allocation at the target date and continues to taper down gently over the next decade. For the vast majority of long-term investors, through funds are structurally superior because they prevent your portfolio from losing its purchasing power to inflation too early in your golden years. If your employer offers a low-cost, index-based target date fund, it is an exceptional, rock-solid core holding. But if the choices in your plan are overpriced or poorly structured, you need to know how to step up and build the portfolio yourself.
To build a highly optimized custom portfolio yourself, you don't need a complex array of alternative investments or niche products. You only need to master 4 foundational asset classes. Let's break down the exact mechanics of what these assets do and why they earn a spot in your portfolio. Asset Class 1. Total U.S. Equities, the growth engine. The United States stock market represents the most powerful wealth creation engine in human history. When you buy a total U.S. stock market index fund, you are buying a slice of every single publicly traded corporation across the entire nation, spanning large-cap giants like Apple, Nvidia, and Microsoft, all the way down to small regional micro-cap industrial companies. The mathematical beauty of a total market fund is that it is market cap weighted. This means as great companies grow larger, they automatically occupy a bigger percentage of your fund, while failing companies shrink into irrelevance. You never have to guess which individual stock will win. You simply own the entire economic engine. Historically, over long horizons, this asset class has delivered an average annual compound return of roughly 10% before adjusting for inflation. Asset Class 2, Total International Equities, the global hedge. While the United States market is incredible, it does not hold a monopoly on global innovation or corporate profitability. International equities encompass all publicly traded corporations outside of the United States. This includes developed markets like Germany, Japan, the United Kingdom, and Australia, as well as emerging high-growth markets like India, Brazil, and Taiwan. Holding international stocks acts as a vital structural hedge. There have been multi-year stretches in financial history, such as the 1970s and the 2000s, where U.S. stocks went completely flat, while international markets boomed. By holding global stocks, you smooth out your returns and ensure you aren't entirely exposed to the political, regulatory, or economic risks of a single country. Asset Class 3. Total Fixed Income and Bonds, the shock absorber. Bonds are fundamentally different from stocks. When you buy a stock, you are an owner. When you buy a bond, you are a lender. You are lending money to the U.S. government or to highly rated corporations, and in exchange, they legally promise to pay you a fixed rate of interest over a specific period and return your principal at maturity. Bonds do not exist in your portfolio to generate massive, explosive growth. They exist to serve as your ultimate financial shock absorber and portfolio ballast. When equity markets experience a severe correction or enter a prolonged bear market, bonds typically hold their ground or even rise in value as investors seek safety. This stability gives you the psychological peace of mind required to stay the course without panicking. Asset Class 4. Real Estate Investment Trusts/REITs, the hard asset income. Real Estate Investment Trusts, or REITs, are unique corporate entities that own, operate, or finance income-producing real estate across sectors like apartment complexes, data centers, hospitals, and logistics warehouses. By law, REITs must distribute at least 90% of their taxable income directly to shareholders in the form of dividends. Adding a dedicated real estate index fund provides hard asset diversification, a steady stream of passive yield, and an excellent hedge against inflation, since property values and rental rates tend to climb alongside consumer prices. To tie these asset classes together, wealthy investors utilize what is known as the 3-fund portfolio or the 4-fund portfolio. This framework was popularized by the Bogleheads community, investors who follow the core philosophies of Vanguard founder Jack Bogle. The entire premise is that you can completely outperform highly complex portfolios using just 3 or 4 ultra-low-cost, highly liquid index funds. Let's look at the exact blueprints, including the precise ticker symbols you can search for and implement today across the major brokerage ecosystems. If your accounts are housed at Vanguard, for your total U.S. stock market core, use the ETF VTI or the mutual fund version VTSAX. For your total international coverage, use the ETF VXUS or the mutual fund VTIAX. For your total bond market ballast, use the ETF BND or the mutual fund VBTLX. If you wish to expand into a 4-fund portfolio by adding real estate, add the ETF VNQ. If your accounts are housed at Fidelity Investments, for your U.S. market exposure, use the mutual fund FSKAX. Alternatively, if you are investing inside a tax-advantaged account like a Roth IRA, you can use Fidelity's Zero Total Market Index Fund FZCROX, which has a literal 0.00% expense ratio. For your international allocation, use FTIHX or their zero-fee alternative FZILX. For your total bond coverage, utilize the fund FXNAX. For real estate, look at the Fidelity MSCI Real Estate Index ETF, ticker FREL. If your accounts are housed at Charles Schwab, for your domestic equity foundation, use the ETFs CHB or the mutual fund SWTSX. For your international diversification, use the ETFs CHF or the mutual fund SWISX. For your fixed income allocation, utilize the ETFs CHZ or the mutual fund SWAGX. For real estate market tracking, use the ETFs CHH. Take a screenshot of this list right now. These core holdings represent the institutional-grade infrastructure of long-term wealth building. They are incredibly boring, highly effective, and entirely free of corporate markup. Now that you have your ingredients, you need the exact recipe. Asset allocation is simply the process of determining what percentage of your total capital goes into each of these specific funds. Stocks provide the fuel, bonds provide the brakes. The exact ratio you select depends on your age, your investment timeline, and your personal stomach for volatility. Let's walk through 3 distinct battle-tested allocation frameworks that mimic institutional wealth management strategies. Portfolio Blueprint. 1. The aggressive accumulator, ages 20 to 39. If you are in your 20s or 30s, time is your greatest competitive advantage. You have a multi-decade horizon before you will ever need to draw a single dollar of income from these accounts. Therefore, your primary objective is aggressive, uninhibited compounding growth. Volatility is not your enemy here. It is your closest friend. When the stock market crashes, your automated monthly contributions act as an acquisition dragnet, buying up great company shares at deep discounts. For this stage, your allocation should look like this. Total U.S. Stock Market Index Fund, 70%. Total International Stock Market Index Fund, 20%. Total Bond Market Index Fund, 10%. If you possess an iron stomach and a rock-solid income, you can completely drop this to 0% and add 5% to real estate and 5% more to U.S. stocks. Portfolio Blueprint 2. The Balanced Builder, ages 40 to 49. Once you hit your 40s, your career is typically in its peak earning years. Your portfolio has grown from a modest savings account into a substantial nest egg. At this stage, a sudden 30% drop in the stock market will represent a massive dollar decline that can cause significant psychological distress. While you still need strong growth to combat inflation, you must introduce a formal mechanism to preserve your hard-earned capital. Your balanced allocation shift should look like this. Total U.S. Stock Market Index Fund, 60%. Total International Stock Market Index Fund, 20%. Total Bond Market Index Fund, 20% Portfolio Blueprint. 3. The Wealth Protector, ages 50 to 60 plus. You are now within a 10-year countdown to your target retirement date. Your primary mission has officially shifted from accumulating wealth to protecting and sustaining it. If a severe bear market hits right as you transition out of the workforce, you cannot afford to be forced to liquidate your stock market shares at the absolute bottom of a market cycle just to fund your basic lifestyle expenses. You need a deep pool of safe, liquid, income-producing assets to draw from while you allow your equities time to recover. Your protective allocation should look like this: total U.S. stock market index fund, 50%. Total International Stock Market Index Fund, 15%. Total Bond Market Index Fund, 35%. You can also carve out 5% of this bond allocation and place it into a dedicated RET index fund like VNQ to boost your tangible cash flow yield. Once your target portfolio allocation is built and automated, your day-to-day job is completely done. You do not need to check your balance every morning, and you certainly don't need to read daily financial news headlines. However, there is one critical maintenance task you must perform exactly once per year: portfolio rebalancing. As the market moves, your asset classes will grow at entirely different speeds. For example, let's say you start the year as an aggressive accumulator with a target allocation of 80% stocks and 20% bonds. If the stock market experiences a monumental bull run during the year, your stocks might grow so fast that by December, your portfolio has naturally drifted to 85% stocks and only 15% bonds. Without realizing it, your portfolio has become riskier than you intended. Conversely, if stocks plummet, your portfolio might drift to 70% stocks and 30% bonds, leaving you underallocated to equities right when they are cheap. Rebalancing is the systematic process of restoring your portfolio back to your chosen target dials. You can execute this in one of two ways. Method 1, the inflow redirection method. This is the most seamless method for active savers. If you notice your stock portion is too high and your bond portion is too low, you simply log into your account and change the settings on your future monthly automated contributions. Direct 100% of your new incoming cash into the bond fund until the total balance naturally levels back out to your target ratio. This method is highly preferred because it requires no buying or selling of existing assets. Method 2, the direct rebalance method. If your portfolio has grown large enough that monthly contributions can no longer easily shift the needle, you must perform a direct rebalance. This involves manually selling off a small portion of the asset class that has outperformed and using that exact cash to purchase more shares of the asset class that has underperformed. When you do this, you are forcing yourself to execute the ultimate core tenet of wealth generation: selling high and buying low. You are taking profits from your winners and buying your laggards while they are on sale. Important note on taxes. If you are rebalancing inside a tax-advantaged account like a 401k, a Roth IRA, or an HSA, you can buy and sell shares at will with absolutely zero tax consequences. However, if you are rebalancing inside a taxable brokerage account, selling winning shares will trigger capital gains taxes. In a taxable account, always try to rebalance exclusively by adding new capital to the underperforming assets rather than selling off your winners. Building a multi-million-dollar investment portfolio does not require an elite financial degree, a country club membership, or a complex trading setup. It requires selecting rock-solid, ultra-low-cost, broad market index funds, mapping them out to align perfectly with your age, and letting the unstoppable engine of compounding interest do the heavy lifting while you focus on your career, your family, and your life. Let's lay out your exact action plan for this week. Do not try to do all of this in one single afternoon. Take it one step at a time. Step 1. Log into your primary investment accounts, whether that is your employer, 401k, or a personal Roth IRA. Step 2. Look up the prospectus or detail pages for the funds you currently own and inspect their expense ratios. If you are paying anything over 0.20%, look for cheaper index fund alternatives on your menu. Step 3. Use our age-based blueprints to determine your target stock-to-bond ratio. Step 4. reallocate your existing balance, or adjust your future automated contributions to align with that target. Step 5. Turn on automatic investing, close the tab, and go enjoy your week. The investors sitting on multi-million-dollar portfolios didn't do anything extraordinary. They simply executed ordinary financial moves the right way for an extraordinary length of time. That is the real secret. If this step-by-step tactical breakdown brought real clarity to your financial journey, please hit that subscribe button, give this video a thumbs up, and drop a comment down below. Let me know, what is your current age? And are you using a simple target date index fund, or are you building a DIY 3-fund portfolio? I read and reply to every single comment on this channel. Thank you for watching Finance and Wealth Matrix. Keep building that gap, automate your future, and I will see you in the very next video.